Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings, so you don't have to. Today we're diving into the Hanover Insurance Group's latest proxy statement. Proxy statements can be a bit dry, but trust me, there are always interesting tidbits hidden inside, like a surprise bonus, or maybe a not so surprising executive departure. Today's proxy is all about who's running the show, how they're getting paid, and a few other things shareholders get to vote on. We'll break it down to see what it really means for the company and your investment. This proxy statement is filed by the company itself, meaning it's their official recommendation on how shareholders should vote. It includes important details about the upcoming annual meeting, who's up for election to the board of directors, and how much the top executives are making. The letter from the chair of the board and the CEO invites shareholders to the annual meeting on May 13th, 2025. It mentions corporate governance, risk oversight, human capital management, and sustainability efforts. It's basically the company's way of saying we're on top of things. At the meeting, shareholders will vote on electing 5 directors, approving executive compensation, and ratifying the appointment of PricewaterhouseCoopers as the company's auditor. We'll take a closer look at each of these items. Only shareholders who own stock as of March 2025 get to vote at the meeting. Here's a quick overview. 9 out of 10 directors are independent. The board chair and CEO roles are separate, and they've added 3 new directors in the last 4 years. It also highlights sustainability oversight. The company had a net income of $426 million, a combined ratio of 94.8%, and increased their dividend by 5.9%. This table shows how much stock each director and executive officer owns. CEO John Roche owns the most, around 1.2% of the company. It's generally good to see executives with significant ownership as it aligns their interests with shareholders. The company has stock ownership guidelines for executives. The CEO needs to own stock worth 6 times their base salary, while other executives need those requirements, which is a positive sign. The CEO owns stock worth 27.4 times his base salary. That's a lot of skin in the game. The other executives also have significant ownership, ranging from 4.4 to 13.3 times their base salary. The largest shareholders are institutional investors like Vanguard and BlackRock. This is typical for a company of this size. Vanguard owns around 10% of the stock and BlackRock owns 9.1%. The company declassified their board. By 2027, all directors will be elected for 1-year terms. This makes the board more accountable to shareholders. 5 people are nominated for election to the board, including existing directors and a new nominee, William Donnell. The board also voted to increase the size of the board from 10 to 11 members. William Donnell recently served as president and CEO of NCSI Holdings, Inc. The company says his qualifications include extensive knowledge and experience in the P&C industry and many years of management experience. The board values diversity and considers it when nominating directors. Currently, 20% of the board are people of color and 40% are female. Also, the board leadership roles has 50% female leadership. 9 out of 10 directors are considered independent. This means they don't have any significant relationships with the company that could compromise their objectivity. The only non-independent director is the CEO, John Roche. The average board tenure is 6.4 years, and 55% of the board has been serving for 0.4 years. The board's commitment to bringing in fresh perspectives while retaining experienced members and engage a third party to find diverse and skilled candidates. The nominating committee identifies and evaluates potential director candidates. Shareholders can also suggest qualified candidates. The company has a written procedure for reviewing any transactions with related persons, meaning transactions involving directors, officers, or their family members. Any such transaction must be approved by the audit committee. However, there are no transactions to report. The roles of CEO and board chair are separate, with an independent chair. The company believes this supports effective management oversight. The audit committee is responsible for selecting the company's independent auditor, reviewing the company's financial statements, and overseeing risk management. The board has determined that each committee member satisfies the requirements of the NYSE listing standards as to independence, financial literacy, and experience. PwC has been the company's auditor since 1995. In 2024, the company paid PwC $3,049,223 $5,049 and $200 for audit-related fees. The audit committee must pre-approve all services performed by the auditor. The audit committee reviewed and pre-approved all services performed by the independent auditor, including non-audit services, in accordance with the policy set forth above. In assessing the independence of 2BUC, the audit committee reviews and considers aggregate fees and other factors for all audit-related and non-audit services compared to the overall audit fee. Now let's talk about how the executives get paid. Here are the named executive officers or NEOs. This includes the CEO, the CFO, and other top executives. The NEOs include John Roche, Jeffrey Farber, Richard Levy, Brian Salvatore, Dennis Kerrigan. The company highlights its financial performance for 2024, including a net income of $426 million. It also increased its quarterly dividend by 5.9% and bought back some shares. The short-term incentive plans pay out a whopping 150% of target due to the company's strong underlying performance and achievement of strategic objectives. The company uses performance-based restricted stock units, or PBRSUs, to incentivize long-term performance. These awards vest over multiple years and are tied to metrics like total shareholder return and return on equity. Executives are required to own a certain amount of company stock and are prohibited from hedging or pledging their shares. These practices are designed to align their interests with shareholders and prevent them from taking excessive risks. The company has a change in control plan, or CIC plan, that provides benefits to executives if they're terminated after a change in control. This plan is designed to keep key executives focused on the company's interests during a potential takeover. The compensation committee determined this independently of other compensation considerations. For non-employee board members, the compensation committee uses market data and industry surveys to come up with its recommendations. Structured for the 2024-2025 year, each director gets stock valued at $150,000 and cash of $105,000, while committee chairs get even more. Some brokers may be householding proxy materials, sending only one copy to multiple shareholders in the same household. Contact the company or your broker if you want to receive separate copies. This section defines the non-GAAP financial measures that the company uses, such as pre-tax operating income. As a reminder, GAAP should always be the first point of reference when you analyze financials, so what's our take after reading this filing? Hanover seems to be in a stable position, with increasing revenue and emphasis on being environmentally friendly while still turning a profit. Their commitment to diversity is also a good look, both socially and for avoiding any potential public outrage. One potential area of caution is the reliance on stock-based compensation. It's great for aligning interests, but it can also dilute shareholder value. Overall, the Hanover Insurance Group seems to be on a steady course. They're focused on long-term growth and profitability while also maintaining good corporate governance practices. Thanks for watching. If you enjoyed the video, please subscribe, like and comment down below. And if you didn't enjoy the video, tell me why.